Success in your business means you will automatically qualify for a home. You could be crushing it in your industry, have a thriving business, and still get slapped with a loan denial. Not because of how much you earn, but how the system sees your income. If you keep ignoring how banks evaluate business owners, you'll keep hearing no and lose out on homes you easily should qualify for. Let's fix that now. I'm Andrew Russell, owner and founder of RCG Mortgage, four-time winner of Broker of the Year through NAMBI, top originator across the country via Scotsman Guide, and I specialize in working with self-employed clients, entrepreneurs, contractors to help them get the right mortgage products and achieve real estate riches. All right, guys, we just had a specific scenario that actually fit right into this conversation. Let's call the man David. So David was actually buying a home, owned a very successful local digital marketing agency where they work with different entrepreneurs and business owners himself. He actually was an entrepreneur working with other entrepreneurs, helping them grow their footprint on the social and digital side. So it turns out he was making over $1 million a year, and in his head, he was killing it. What's the big deal? So he actually called the big bank, didn't give any documentation. They issued a pre-approval, which is really not a pre-approval. Pre-approval, you're supposed to review tax returns and all the documents to make sure on the credit, income, and asset side that the person's good to go. In his case, they didn't. They just gave him a letter because he had good credit. And he made an offer. The offer was accepted. He went right to the listing agent, so they didn't have an opportunity for a buyer agent to refer him to a great mortgage professional. And as he went into contract, he applied and he got denied, which is crazy, right? He went to contract. He put a deposit down. I think it was something like $100,000, 10% off of $1 million, went through the process, paid for an appraisal, and got denied. So it turns out he ended up getting referred to us. The listing agent was like, listen, before you either back out of this transaction or we're going to try to keep your deposit because you got denied. We know a bunch of people. We were one of the names. He actually called us. We answered right away, of course. And we said, look, let's look at the tax returns. I'm sure something went wrong where the lender you were working with just didn't do a good enough job, and they didn't do their diligence up front on the pre-approval side. You should never get a pre-approval and then get denied when you go into contract. Doesn't make sense. If you're pre-approved, you're good to buy. There's no issue typically. You don't go from one to the next and then get declined. There are reasons why it may not work out. Maybe the house value doesn't come in for what you need, or there's issues with title. But if you make a certain amount of income and you're pre-approved for that, there should be no issues when an underwriter looks at it as you're in contract. So we reviewed his tax returns. Turns out he never gave his tax returns to the mortgage professional, which is ludicrous, right? Isn't that the whole point of a pre-approval? And this is the point why you need an actual pre-approval, guys, where they look at your income documents. They don't just assume based on a phone conversation. So based on his tax returns, yes, he made a little over $1 million. I think it was like $1.2 million for revenue. So in his head, he made $100,000 a month. But he had a ton of expenses. He had a net carryover loss. There were a lot of different things that happened. And it turns out he showed about a $60,000 profit for the year. Bank was going off $60,000. Turns out the mortgage payment was going to be about $8,000. He was making $5,000 a month on paper. $8,000 can't qualify based on $5,000 of income, right? So we got declined. We're like, look, unfortunately, they put you in the wrong mortgage product, but great news. You're speaking to us, mortgage broker company that specializes in non-QM. Non-QM self-employed programs are super cool, and the rates aren't all that much different. So we got the last 12 months of his business bank statements. We saw the 80,000-ish, 100,000-ish a month deposits. Sole owner. He really scaled up his business and was killing it, but he was still the sole owner. So say he had $100,000 a month in deposits. We give him credit as 100% owner, right? That $100,000, we give him credit for half of that, $50,000 a month. So he went from $1.2 million a year in revenue, $100,000 a month, where he only showed $60,000 for the year after expenses, $5,000 a month, to $1.2 million a year in revenue. That didn't change, which is $100,000 a month. But now we can give him credit for half of that because $100,000 at 100% owner of the business, there's no takeout for that. We give him credit for half of that for income. So we went from $2,500 a month of usable income to $50,000 a month. What is that, 20x? We 20x his income. So at a $50,000 a month income number, which we gave him credit for, he can qualify for up to a $25,000 mortgage payment, which is wild. Nowhere near that. So it just shows you he was being put into the wrong mortgage by the mortgage company that he was using, and they just didn't offer non-QM. So it's no shame on that loan officer. I mean, shame on them for not reviewing the tax returns when you issue a pre-approval. It's a huge no-no. Bad mortgage loan officer, bad. But on the self-employed side, the non-QM side, you have to work typically with a broker company who has access to all this stuff. So as you can see, we went from a big fat no to a big fat yes, and the rate was only a quarter higher. But at that point, he was super desperate. I'm sure he would have, in a free market, paid more. But That's not how it goes. He gets the best rate available. So the difference of the non-QM bank statement program, where we gave him credit for $50,000 a month in income, was actually only a quarter higher in rate on a 30-year fix than it was the tax return program, which he literally would have qualified for a $2,500 payment, which I don't even think covered tax and insurance. But of course I hear, hey, Andrew, I don't understand. Like, this guy, he makes so much money. It's impossible. Something's up here. How does he not qualify? Because it's just he or she. I say this all the time. He or she who has the money makes the rules. The rules are for a conventional mortgage, they're going to look at your tax return for the last year. So right now, if it's September, last year is what they look at. So January to September, if you're killing it on your self-employed entrepreneurial, contractor position, whatever it is, they just don't care. They're looking at the last year tax returns, maybe even 2 years, depending on the type of loan, and they're looking at your profit, not the revenue. It's revenue minus expenses equals profit on paper to the IRS. Great news. In this country, we give you the opportunity to write things off. Unfortunately, we're going to take those write-offs, look at that profit, and that's what we use. So just because you make oodles of money every single month doesn't mean that's what we're going to give you credit to qualify for. And of course, I always hear, hey, Andrew, but my CPA, he's awesome, right? He's the best. We'll figure it out. Well, you don't figure it out. There's nothing to figure out. You know what we figure it out with? The tax return. So like I said, it just makes sense if you're self-employed. Always do a due diligence pre-approval and make sure if you're trying to do the conventional mortgage route or a jumbo mortgage or portfolio mortgage, that the tax returns, whether it's the last year or the last 2 years, that the profit, that bottom number we're going off, is enough. Because otherwise, you're denied on arrival. You have to go right to the self-employed programs, which are just as good, which are still great, but you don't want to have false expectations of rate being a little bit better or a little bit more streamlined. So just make sure, regardless of how good your CPA is, that you go to the right mortgage type. And of course, I hear all the time, hey, Andrew, I got approved before. 2 years ago, I was self-employed and I bought a property. Why can't I now? Because it doesn't matter what happened 2 years ago. 2 years ago, I was jacked with a full head of blonde hair, right? Probably not, but maybe the jack. But regardless, 2, 3, 5 years ago, we go off of the last year or last 2 years of your tax returns. So then, even if you made the same amount of revenue, maybe you didn't write off as much stuff. Maybe the depreciation was a big write-off, which we can add back. Some of the stuff is kind of, there's a little bit of wiggle room. But maybe last year, specifically last year, although you had the same amount of revenue, maybe you invested into your company. Maybe you had a lot of expenses. Maybe you took on more staff. Because of that, that bottom line number for profit went down. So just because you killed it the last year, maybe even more revenue than a couple of years back, it's different, right? So when you're W-2, hey, I'm a teacher, Andrew. I make $100,000. 2 years ago, I made $90,000. That's easy. We go right off the W-2 when you're self-employed. There's a lot of stuff that goes into it. So just because that revenue, that top line number, what you bring in every month before expenses, was very high, even now versus a couple of years ago, doesn't mean you qualify now. Because what we look at is that net profit. So just because you killed it in the last year or so, we look at what it shows on paper, and thank God for these alternate programs. All right, so right now I'm going to go over 5 core concepts, typical issues and things if you're a self-employed business owner, entrepreneur, of what you run into when you're trying to qualify for a mortgage, and some of them, what we can do to kind of sort of fix them. But before I do, guys, make sure go in the description and click the link. My team prepared an amazing self-employed cheat sheet. It's got all the stuff. They spent a lot of time on it. Just make sure you go in the description, click the link, and you get a free copy of it. No, we're not going to stalk you out and be texting you all night, all up in your DMs, but just make sure you go in the description and click the link, get our free self-employed cheat sheet. It's awesome. All right, guys, I'm famous for this Sharpie. I've actually been away on vacation in Mexico in an infinity pool, and someone's like, hey, I know you. I'm like, oh God, did I know you from the Hamptons when I used to do security? No, you're the guy with the Sharpie on YouTube. I'm like, fact of the matter is, you're correct. So we're gonna hit the Sharpie because the first thing, guys, of the 5, the first thing is, know what actually counts as income when you're self-employed. So number 1, we're just going to talk income. Question marks, right? So you're self-employed. Just because you're smart and you're killing it in your space, whatever, like as the example before was digital, or you own restaurants, or you're a real estate agent crushing it, financial advisor, insurance. Just because you know these spaces doesn't mean when an underwriter gets your application to buy a house, what on all your documents they're going to look at and say, this is how we ascertain or figure out, big word, guys, your income, right? So income, think about it. Right now it's 2025. So if you're doing just to keep it simple, a conventional mortgage, we're going to go off of 1 year tax return if your business has been open 5 or more years. So this is a cool guideline. Just as an example, it's kind of on an aside, but it used to be a thing if your business is open 5 or more years, You could potentially do a 1-year average, which is a lot cleaner. Sometimes you had to run it through the automated approval system, and it would tell you if you could do 1 year, which is a lot cleaner than 2 years, because if you do 2 years, they look at declines of the net income. If it's over 20%, they may disqualify you completely. But let's say this is the case in 2024, right? So you own a business. In the case of our digital marketing example, remember, he made $1.2 million in revenue. So if you remember a tax return, it could be a Schedule C, it could be an S Corp, right? It could be anything. The top R, we'll call revenue, 1.2. And in your head, Mr. and Mrs. Entrepreneur, you think, I crushed it, 100,000 a month, which is, that's no joke. You're in the 2 comma club here. It's legit, right? I make 100,000. So if I wanted to buy $1 million house, 20% down is an $800,000 mortgage. Say it's about $5,600 a month. Taxes and insurance. Say you're at, I don't know, $7,800 a month. This is all very rough, guys. We're talking typical rates of 7%, 7.5 APR, just very, very, very rough. But with that said, that's $7,800 a month. If you're making, in your head, $100,000 a month, which is wrong, which we'll go over, who couldn't afford $7,800 a month? But remember, right, this $100,000 a month, that's not what you make. Not in the eyes of a conventional portfolio or jumbo underwriter. They're going to look at your expenses, which are right in your tax return, right? Revenue minus expenses equals profit. I have 2 little kids, 7 and 9-year-olds. Shout out to D&G. I don't think this is how they do math anymore. They've made math so ridiculous. I was going to say stupid, but it is stupid and convoluted. But I don't even know if this is how they do it on the charts. I did go to a really good school, and this is how they taught us 107 years ago, so I'm going to go off this. But the 1.2 in revenue, say for whatever reason, as we said, there's a lot of investments in the business between all the expenses, and the person gave themselves a $60,000 W-2, it whittles down to that $60,000 because 1.140 are the expenses, right? So even so, that $60,000 could be as a W-2, as a wage. Not only was there no profit, that $60,000 could be shown up here as a wage. And that person's the owner, so this kind of comes down here as they make $60,000 for the year. There was actually no profit. I've seen that too. Instead of just giving yourself a K-1 or some kind of distribution, they write all the expenses off to zero and just place it up here as a $6,000 W-2. So if you remember in the example of the gentleman, $60,000 over 12 is $5,000 a month, right? So he went into the big bank, was kind of like too cool for school, and he was going to qualify, and they're like, cool, we'll just give you a letter, you have great credit, which is not, we don't just base it off of credit, there's a lot more that goes into it, which as we've spoken about in multiple YouTube videos. So that $60,000 of profit, which is really his W-2, net profit for the business was zero, that $5,000 a month, assuming great credit and no debt, he only gets credit for a $2,500 max mortgage payment, which is crazy. So if you look at it, that $7,800, escrow was $2,400, which was his taxes and insurance. So he only, on paper, on his tax return for 2024, star this puppy up, showed enough to qualify for tax and insurance. He wouldn't have been able to get $1 in mortgage. So that $800K would have turned into a big fat zero. Womp womp, no mortgage, because you write off all your stuff. So just remember, as it relates to income, if you're in your head, if you're self-employed and you're doing well, if you remember, if your books, you're right on top of your figures. I mean, I am. Some entrepreneurs, they aren't all over their figures. They have a CPA. But the revenue for the year, that's not what you make when you go to qualify for a mortgage and you're doing a full documentation type loan. What you actually make is, after the expenses, whether you give yourself a W-2 or not, you make that net amount after all these expenses, which I've seen businesses like this show a loss. Not only you make nothing, you make negative money based off of the year. So that's always something for you to look out for. Now, this is if you did the normal conventional route. Now, if we turn this into, as we've alluded to, the bank statement program, the non-QM program, it's a total different calculation. Number one, the tax returns. And yeah, that was very basic, aggressive, illustration I just gave. I'm not a good drawer here or a cartoonist, but nonetheless, the whole point is we don't need your 2024 tax returns. We're going to look at the last 12 months of bank statements. So as you can do the math here, 1.2 for the year, it's about $100,000 a month on average for deposits. So that's the revenue. Now this person, if you remember, they were a 100% owner of the business. We get credit for all the 100 before the expenses. Now the expenses on these programs, the bank statement programs, they go off of a 50% expense factor. So 50% of 100 goes down to $50,000 a month, which is a lot, right? Especially versus $5,000 a month. So that $5,000 a month just turned into $50,000 a month, which is huge. So you go from $5,000 a month. Now this new way, if it's $100,000 a month of deposits, half of that is $50,000. You just 10x'd your income just by using the right program, which is super cool. So just remember, food for thought on the first piece on the income side. Just because in your head you're killing it on the revenue side, you have to do a full due diligence pre-approval, because the way we figure out income, it depends on the loan type. As you can see, if you did the straight up conventional, it just wouldn't have worked. $5,000 a month or $60,000 for the year is just not going to move the needle on $1 million sale price with 20% down. But if we do a non-QM, a bank statement program, for instance, which I talk about all the time on my channel, guys, make sure you check out the other videos. So many about this. I love talking about it. Our last 12 months bank statements, $100,000 a month, half of that. It just shows the increased purchasing power if you just do the right program with a thorough consult. All right, so the second piece, we're going to do a quick erase job, which we can make very fast with the magic of editing. 3 minutes later. All right, so the second piece is, what does WO stand for, guys? 3, 2, 1. Write-offs. So you have to understand the impact of when your accountant calls you and says, hey, let's do your 2024 taxes, right? Oh, you made, I don't know, $250,000 as a real estate agent on your 1099, which is great. $20,000 a month, you're doing pretty good. Oh, by the way, do me a favor, send in all those things called expenses. I'm going to see what we could write off so I can save you a couple bucks, because it's tax season. You're like, all right, thanks, Mr. Accountant. So you send in all your expenses, and the expenses total, I don't know, $190,000. What could this be? How could you possibly have that many expenses? You have car and travel, you have meals and entertainment, you have advertising, you have marketing, which could be a little bit different. You have networking costs. Maybe you have some employee expenses. Maybe you have a assistant. Maybe you have multiple assistants. Maybe you have a buyer agent that you give a business to and give a piece of the action. So obviously that $250, when you write it all off, turns into $60 again for the year. And that's the profit. So this is what we go off of. So just understand, this happens all the time when people say, hey, Andrew, I crushed it in 2024 or the last year, or even year to date for self-employed. Now remember, write-offs play a huge role in what you qualify for a conventional FHA, VA, USDA, portfolio, maybe jumbo. Oh, the handwriting's getting a little bit spicy. It's a big factor in what you qualify for, the write-offs when you're self-employed for these type of loans. Now, obviously, when you're doing the non-QM suite, which is what your boy loves, you have the bank statements, you have your profit and loss loans, you have your 1099 loans. It's totally different because, again, the tax return, right? I did this on number 1. We're going to do it on number 2. We don't look at them. So on the bank statements, we're going to look at 12 months of your bank statements. On a profit and loss, we're going to say, hey, give us a 12-month profit and loss with your revenue, your expenses, and your net profit from that period of time in that snapshot, without looking at your tax returns. Or the 1099. What's your YTD year to date? And then last year, maybe even the year before. What'd you make on your 1099? What's your year to date? And we're going to use 90% of that, which is a 10% expense factor. If you do the math here really loose, a little over 20% is actually the income, not the expenses. So over here, you have about an 80% expense factor. So just remember, now you have a 90% income. So you only have a 10% expense factor if you're a 1099 agent versus 80%. So it's so much less in expenses to give you credit for so much more to qualify. So again, just to reiterate, the write-offs, if you're self-employed, make sure if you want to buy with a conventional FHA, VA, USDA, portfolio, jumbo, you're cognizant of what you're giving to your CPA to write off, because we're only going to go off that profit number after all the expenses. And these non-QMs, Write off all the stuff you want, guys. Go crazy. Make sure it's legal, of course. We always condone doing the right thing, obviously from an IRS tax code perspective. But on the non-QM suite, whether we do the bank statement program, a profit and loss program, or a 1099 program, we don't look at any of this stuff. Go nuts, write off what you're allowed to, because we're going to go off some different stuff. But always make sure you're cognizant of your write-offs. Now, the third thing, guys, and we're going to obviously speed through a little bit of a race job, is making sure you use the right loan type. Here we go. I know it's harder to erase or to do mortgage. All right, so the third, we're going to say loan type. All right, so remember, when you're self-employed, we have, let's call it vanilla. Who doesn't like vanilla? And then chocolate. Who doesn't like chocolate? Let's pretend chocolate's a little bit spicier. I'm not sure that's really the case. Everyone loves chocolate. But vanilla, let's say this is going off the tax returns. And chocolate, let's call this non-QM. So, of course, most people think, hey, I'm going to go buy a house. I'm going to inquire with a big bank or with somebody. They're going to ask for my tax returns. So we're going to go off of, say, your 2024, 2023 on some of them, like FHA, VA, USDA hasn't adopted the one-year average yet. Why? I really don't know, but they just haven't. So this is more unconventional if your business open 5 or more years. But this is what we're going to look at to qualify you. So depending on the loan type, we look at different stuff. Now, the chocolate side, let's say non-QM. Again, bank statements, let's say profit and loss, and 1099. So just understand, when you go in to get pre-approved, if you have any type of knowledge on your expenses and what you actually wrote off, or even if you have your tax returns, look at them and see, did I write off a lot of stuff per what that guy Andrew on my YouTube said? Or do I show off super high profit, which you would know because you would be paying the IRS a ton in tax liability. So if you're like, oh my God, last year I got whacked and owed the IRS $100,000, you probably qualify for the vanilla-ish stuff because you didn't have that high of an expense. Your profit was high to the IRS, so you pay them a lot of money. Or, man, we showed a loss. Or, we didn't really have to pay the IRS that much this year. I'm not sure how, what my CPA did, but nonetheless, we didn't have to pay them that much. You're probably going this route, right? So the difference is typically the bank statement programs are probably about a quarter higher in rate. Now, is it worth it? Of course it is, because typically we've seen the average loan size, this is like an extra $8,000 in closing costs to buy the rate down, right? So if the going rate is 7% and 7.25% is the bank statement program, if you pay 1% of the loan, it's called a point, right? So on $1 million, 20% down, $800,000 loan, 1% is $8,000. I'm sure you follow me. If not, rewind and rewatch what I said. That $8,000, it's cool because it saves you to qualify for that same loan. Maybe you would have had to pay the IRS, I don't know, $80,000 in federal tax debt to show a higher profit, right? Less expense, higher profit to qualify. But now you're paying the IRS $80,000 versus $8,000. So we can save you 90%, a 90% swing differential just by doing these programs. So I just want to give you a clear illustration, guys. This is what my goal is here, to show you. People say, oh, it's a quarter higher in rate. It's the end of the world. Oh my God, WTF, what are we going to do? It's actually, it still saves you so much money. But a bank statement program versus our vanilla conventional program, just as an example, it's about a quarter higher in rate. P&L programs, I've seen it as high as another 0.5% in rate, right? So again, same concept. Instead of 7.25%, now you're at 7.5%. But a P&L program is typically, if the bank statement program as the first line of refusal doesn't work, then you go to a P&L program. That's simply if you're more so if you are a seasonal, maybe 3-4 months of the year you crush it, the other months you don't. So you work off of the P&L just so they don't see the last 12 months, because some months may be at zero or not that much, and they think your income might be volatile, your revenue is volatile. So P&L is better because they don't actually look at your bank statements. So they're going to look at the P&L, just the revenue and the expenses, which is cool. Or kind of like a third option is a 1099 program. 1099 programs, typically the rate could be even at the same par, could be a quarter higher, could be a half higher. Depends on the lender and a lot of different factors on these programs. But again, this is only niched out for a 1099 contractor. So some people get a 1099 and they get a 1099 from the same place for over 2.5 years. So we'll go off of the last 2-year average. So say, for instance, 2023, 2024, and then like I said, YTD. So say for instance in 2023, you made that 200. 2024, you made 250, and then let's erase this. And then let's say in year to date, right? So it's 223, 250, 24 for your 1099. And year to date, say right now is 10/1/25, so that leaves 9 months. So in 9 months, you made 180K, which is about 20 a month. They will add this all together. So you have 12 months here, 12 months here, and 9 months here. So you have 24 and 9, so you have 33. So they're going to add 200 plus 250 plus 180, whatever that big number is, divided by 33, and it'll be somewhere around $20,000 a month, give or take. Now that $20,000 a month, we don't just stop there. They take 10% off the top for expenses. They don't look at tax returns, which is so cool, right? They just take 10% off the top. So now they're giving you credit for $18,000 a month in income. So not everyone, when you're self-employed, most people don't necessarily get 1099s. That's if you're a contractor or they're issuing 1099s, whoever's paying you. Typically, we do bank statement programs or even a P&L if needed. But if it is, for whatever reason, if you're a 1099 contractor, there's a lot of spaces that are 1099, like real estate agents, as an example. We're going to go right off that 1099, make sure that the trends year over year are the same or growing, especially year to date. And we're only going to do a 10% haircut. But just make sure, guys, as you can see here, when you try to pick your loan type, just be honest with yourself, because you can't mess around with tax returns. Do you write off all this stuff? And if so, make sure on day one, you gear your pre-approval to the chocolate side. So the fourth one is, very important, filing strategy. So what does that mean? Taxes are typically due to be filed early in the year. Now, sometimes you go on extension, but if you're doing a conventional mortgage or an FHA and we're going off the actual tax returns, I've seen people make huge boo-boos. So what do? We spend all this time helping them, coaching them up on what expenses they can't write off, and if they're okay with it and if they pay all that IRS tax, that cool, they qualify. So we help them and we structure the mortgage accordingly to a conventional mortgage, specifically getting them a better interest rate potentially. And then what do? Tax season comes. They just file behind our back. Don't tell us, don't let us look at it, and basically shoot themselves in the foot, because the lender will say, hey, taxes are due now. Show us proof of extension. Well, I didn't extend. Well, show us the tax returns you filed. Here they are. Can't really undo it once you see it, right? So your strategy is super important, right? Ideally, in a perfect world, if you're in process, just stay on extension. Typically, nothing you can do from a filing perspective when you're self-employed will ever help you real time. It's always better to kind of put it off till after you buy, just so you can take a breath and see what makes the most sense for you. Or, most important, when you're either going to get pre-approved or buy a property, never, or even refinance, never, ever, ever do your taxes behind your mortgage professional's back. We always have to see it, because I can't tell you how many times it's like that magical thing that happens on a refi. Sometimes people on a refinance, they don't realize as you're going through the process on a refinance, you have to still pay your mortgage on time. They think if they're going to pay it off and get some cash out, that, for whatever reason, they don't have to pay it. So you get an updated payoff. You're like, oh my God, it says there's 2 months of interest. How's that the case? Well, I didn't make last month's payment. That could potentially, get them a mortgage denial. And you're like, oh my God, all that was for nothing for them. I feel so bad for them. Same thing on a purchase. You can go into contract, risk a deposit, and throughout the process, being self-employed, do the wrong thing behind your mortgage professional's back. So your filing strategy always has to be tip of the tongue, top of the brain. Never do anything behind their back. But also, if you're in process, it's always safe to just extend. And the fifth one, guys, which is super important and maybe even the most important decision that you make in general, is the who. No, not the band. I think I'm too young even to like them. But regardless, who are you going to work with to get you the mortgage to buy? Now remember, typically there's 4 types of institutions that you can work with to get a mortgage. And I'm going to save the best for last. And it's not self-serving, I promise. It might be a little self-serving. The first is a big bank. Second is a credit union. Third is a mortgage bank. Fourth is a mortgage broker. All right, first, big banks. Typically, you have your money there, right? Your checking, your savings, depository institutions, ATM cards, brick and mortar. You could walk into them. Local banks, big banks, right? So they typically specialize in jumbo loans. They've definitely cornered the market for the jumbo loans. But I think at this point, none of them actually offer non-QM self-employed mortgages. So majority of the time, self-employed clients never qualify because they're always writing stuff off. The likelihood of them qualifying is so low. And I've worked with so many of them. So just in your head, you're self-employed, you're a business owner, you're an entrepreneur, 1099, you're going to have to work with someone who specializes in non-QM or self-employed loans. Typically, big bank is definitely not the answer. The second one, credit unions. So credit unions specialize in, sweetheart deals on auto loans, typically HELOCs, maybe some first-time home buyer programs with low to moderate income where they literally give the house away. But again, similar to a big bank, although you can bank with them, a credit union, under certain circumstances, they do not specialize in non-QM loans. They actually may not even offer them as well. So again, you're self-employed. You want to put yourself in the best position for success. You want to work with companies that actually offer the programs. Now, mortgage banks are good companies, but they're just one, right? So if you go to a bank, and mortgage banks could offer a full suite of product, which is FHA, VA, USDA, conventional mortgage, maybe non-QM, maybe DSCR, all these cool new program types, but you're at one place, right? So that one place, when they review your application, they may not specialize this mortgage bank in all of them, meaning they might be good at conventional, but not at FHA, or they might have access to a decent bank statement program, but not profit and loss. And typically, their rate and fees are a lot higher. It's been proven that mortgage brokers, which we're saving the best for last, are cheaper both in rate and closing costs. So a mortgage banker is a decent option. It's okay for self-employed. It's definitely better than the first two. But even then, it's not like, listen, if you're going to do something, if you're going to get heart surgery, don't you want to go to the best heart surgeon? Same concept if you're self-employed and you're going to buy $1 million property, you want to go to the right company. Now, save the best for last, of course, a mortgage broker company. So mortgage brokers have access to all the banks. So what's cool about us and what's unique, RCG Mortgage's mortgage broker, is depending on the loan type, specifically like the granular details. Is a P&L program, is it bank statements, is it 12 or 24 months, what's their credit score, what are they putting down, where are they buying, is it a jumbo loan, is it a small to moderate type loan sizing? There's so many factors that go into it. So a broker does all the shopping around for you because they're on with all the banks. It's cool actually being a broker. If a bank comes out and specializes in non-QM, we can reach out to them and sign on with them within 24 hours. So it's almost like we're an extension of them within 24 hours. That quick, we don't have to change companies, change our email addresses, right? And we can offer their programs pretty much instantaneously, but we're the one that does everything. We do it for a small fee. So they actually regulated how brokers are compensated. You've seen all the movies. We used to make money from the lender and from the borrower, from the client. So sometimes a broker would cost more because they have inflated fees. That actually got eliminated. So now we can either make money from one or the other. We can't make money from both. So because of that, we're the wholesale, space. Because of that, we really make money on volume, on referrals, on past clients referring us, current clients having great experience and referring us. That's the money with more clients, not more money on the one specific client. So the broker company is the best option for self-employed because depending on the qualifications, the credit score, how much money you have left over after you close, are you doing a bank statement program, is it a profit and loss program, they will set you up with the best lender for the specific program needed, and they always get you the best deal. So now that you know why you're getting denied and what to do about it, make sure, guys, you watch my next video, how to stop your mortgage rejection, how to stop it in 25 minutes. I'm gonna go over how to turn that no into a big fat yes and all the strategies and hacks that we have. So make sure you click the link here, guys, and watch the next video.